Welcome to lecture 22 on risk management and insurance. In this lecture, we use the insurance capital asset pricing model to determine the optimal underwriting return and optimal premium income of an insurance company. The capital asset pricing model implies that all assets yield the same risk-adjusted expected return. This also applies for shares of insurance companies. In equation 27, mu k stands again for the return on equity of an insurance company. The equation shows that the return on equity can be divided in two components: the risk-free interest rate and the risk adjustment. The risk-free interest rate may be the American Treasury bill rate. American Treasury bills are usually considered to be virtually risk-free. Now, the risk adjustment depends on the return of the market portfolio. The market portfolio includes all shares in the share market, so it is very large. And each share carries a weight that reflects the size of the firm. So mu m shows the weighted average of the returns of all shares in the share market. Now beta k measures the co-movement between the return on equity of the insurance company and the weighted average return of all shares in the share market. Now, when this co-movement is strong, then beta k is large and the risk adjustment is big. So a share is considered to be risky if there is a strong co-movement between the return of that share and the market return. Now, this we have to discuss a bit more on the next slide. In the capital asset pricing model, we distinguish between unsystematic risk and systematic risk. Unsystematic risk is a firm-specific risk that can be diversified away by buying a lot of different shares. So, for example, the risk that management of the firm makes a bad decision, that's firm-specific risk. And you can get rid of that risk just by buying the shares of a lot of different firms. In contrast to that, the systematic risk is a risk of the market portfolio which cannot be diversified away. Consider an investor who holds the market portfolio. Such an investor holds every share in the market. Such an investor is very well diversified. So the investor no longer has any firm-specific risk. So investors bought every share in the share market with the appropriate weight, okay, that reflects the size of the firm. So the investor holds every share, so the investor no longer has firm-specific risk, but the investor still has the market risk. And that market risk, the investor cannot get rid of by buying more shares, because the investor already has every share in the market. So the market risk cannot be diversified away, and a share that moves strongly with the market is considered to be a risky share. That's what we have here in equation 27. So if we have a strong co-movement between the return on the share, mu k, and the return on the entire market, then beta K is large, and we have a large risk adjustment. With a strong co-movement between the two returns, the share is risky because the risk of the market return cannot be diversified away. This may be a bit of a new idea if you've never heard about the capital asset pricing model. So an investor does not get compensation for the firm-specific risk, for the unsystematic risk. The unsystematic risk can be diversified away. So the investor, if the investor has a well-structured portfolio, then the investor no longer has a firm-specific risk. And so there's no compensation for this firm-specific risk. But the investor gets a risk adjustment, gets compensated for the market risk, for the risk of the market portfolio, because that risk cannot be diversified away. If the investor holds a market portfolio, then the investor holds every share in the market, and so there's no possibility to do more diversification. So that's a basic insight of the capital asset pricing model. Now let's consider a share that moves completely independently of the market, of the stock market. So beta K is 0. Such a share is risk-free and therefore earns the risk-free interest rate. Mu K is RF. So if the share is completely independent of the share market, has no relation to the market return, then beta K is 0. And so there is no risk adjustment. The share has no risk, and that's why the share then simply returns the risk-free interest rate. And here we have a 0. Now let's look what happens if the share moves 1-to-1 with the stock market. So beta K is equal 1. Such a share is equivalent to the stock market. If the share is perfectly correlated with the stock market, moving 1-to-1 with the stock market, yes, then that share should naturally give you the return of the stock market, because the share is basically equivalent to the stock market. The behavior of the share is equivalent to the behavior of the stock market. So if beta K is equal 1, then you have your RF minus RF, that drops out, and you just get mu K is equal mu M. So if a share moves 1-to-1 with the stock market, then that share, the behavior of that share is equivalent to the behavior of the stock market, and so the share should also give you the return of the stock market. And that's what you get here in this equation. With a 1 here, beta K1, then mu K is just equal mu M. Now that was a short review of the main ideas of the capital asset pricing model. It will be sufficient if you know this for what follows in this chapter, but naturally it was a bit short. And so later on, we will do an entire chapter on the capital asset pricing model. So we will go a little bit more into detail. Now the capital asset pricing model holds for any asset and also for combinations of assets. So a combination of assets is called a portfolio. So for example, the investment portfolio of the insurance company, that's a combination of assets. An insurance company holds, invests its funds in different assets. Now in the insurance CAPM, 3 betas matter. Beta K, which we just discussed, which shows the co-movement between the return on the shares of the insurance company and the market return. Then beta P, which shows the co-movement between the return of the investment portfolio of the insurance company and the market return. So we can really calculate betas for combinations of assets. The investment portfolio includes a lot of different assets, but those assets then have an overall return, and the co-movement between the overall return of the assets in the investment portfolio, that co-movement with the market return is measured by the beta P. And beta U measures the co-movement between the underwriting return of the insurance company and the market return of a portfolio that includes all shares in the share market. Now we can illustrate this a bit with the balance sheet of an insurance company. So remember, a balance sheet of an insurance company, on the left side we have all the assets. On the right side we have all the liabilities at some given date. The assets are the investment portfolio of the insurance company. So for example, bonds, shares, real estate, and so on. On the right side, the liabilities of the insurance companies, they arise because the insurance company has liabilities towards insurance buyers. Because that's the present value of all future payments to insurance buyers when those insurance buyers experience some losses, because maybe they have an accident or there is a house fire. And then here we have the capital of the insurance company. Let's call it CAP. Yeah, okay. So that's the capital of the insurance company. That belongs to the shareholders. It's excess of assets over liabilities. And that's what belongs to the shareholders. That's the equity. Now the beta K refers to the co-movement between the return on equity and the market return. So this is related to the equity of the insurance company. Beta P is related to the investment portfolio of the insurance company. It refers to the co-movement between the return on the entire investment portfolio and the market return. And beta U is related here to those liabilities of the insurance company. The insurance company has liabilities toward the insurance buyers because it has underwritten insurance contracts. So here, okay, that's coming from the underwriting business. That's a beta U. So that's the three betas that we use in this lecture here and in the insurance capital asset pricing model. Okay, I hope this figure is somewhat helpful. Now we can solve the CAPM, the insurance CAPM, for the underwriting return, so optimal underwriting return and optimal premium income. And it's done in the following way. Now, equation 26 and 27, they give you expressions from UK for the return on equity of the insurance company. So that's this one here. That's on 26. 27 gives you another expression from UK. That's coming from the CAPM. And so we can put the two equations equal. So that's what I do here. So that's coming from 26. And this here is from UK from 27. And this equation we would like to solve for the optimal underwriting return, okay, or the optimal underwriting return, which is optimal in the insurance KPM. Now we know everything here in this equation except mu p, that's not yet known, and beta k. So we need now expressions for mu p and for beta k. Mu p, so that's just the return on the investment portfolio of the insurance company. Here we can again apply the KPM. The return of the investment portfolio equals the risk-free return plus a risk adjustment. Now this risk adjustment actually now depends on beta p. The co-movement between the return on investment portfolio of the insurance company and the market return. Then beta k is a linear combination of the other two betas, beta p and beta u. And it's actually the same linear combination we already had in equation 26 with the same weights. So let's go back to 26. So here mu k was a linear combination of mu p and mu u. Okay, here's those returns. And here we have the weights, which depend on the leverage ratio and here the funds generating factor. Now we get basically the same linear equation for the beta. So the beta k is this linear combinations of the beta p and beta u with the weights that we had before. That's because everything is linear and so the returns, mu k, mu p, mu u, they go into the covariances in the numerator of the betas in a linear fashion. So everything stays nicely linear and we get here again the same weights. Now the algebra I don't show, it's a bit tedious. So we have now two expressions for mu p and for beta k. And we can plug it in here. Mu p, beta k. So we get here a very long equation and we can solve that equation now for the optimal underwriting return. So that's what we get. That's a basic equation of the insurance capital asset pricing model. And once you have the optimal underwriting return, you can put this into the equation here, put the number from up here, put it in here, and you will get the optimal premium income. This we just simply rearrange equation 24. That's very straightforward. So what we see here, the optimal underwriting return again involves here a risk adjustment, which is given by the beta u. Underwriting is risky. The underwriting business of the insurance company is risky if we have a close co-movement between the underwriting return and the market return. Because this market risk cannot be diversified away. But then we have here a negative item, and this negative item appears here because the insurance company, and therefore also the owners of the insurance company, the shareholders, they get the credit from the insurance buyers. Remember, the insurance buyers pay the insurance premium at the beginning of the year, but the losses occur then during the year, and insurance payments will be even later, or maybe even later. So basically, the insurance buyers give a credit to the insurance company, and so that's a benefit that the insurance shareholders of the insurance company have. And this we have to subtract here, the value of this credit. So the underwriting return is again a risk adjustment here. The riskiness of that reflects the riskiness of the underwriting business, adjusted for this credit that the insurance buyers get from the shareholders get from the insurance buyers. So here again, I explain, okay, this risk premium that is included in the insurance premium in the end. This is a risk premium goes into this underwriting return, so the underwriting return goes into the optimal insurance premium. Okay, we can now mu, the underwriting return, may be positive or negative. It's negative if here the beta u is negative. So if the underwriting return moves against the market return, so maybe the market increases and then the underwriting return falls, so really the beta u can be negative. In that case, we have here two negative figures. And so then it's actually optimal to have a negative underwriting return. It's what the capital asset pricing model predicts. Now, if the beta u is 0, or even if it's small, then maybe this negative item here is still bigger than this positive item. So also with a small beta here, okay, you still may have a negative underwriting return. Now, if beta u is low or negative, then underwriting provides an excellent opportunity for risk diversification. Then the underwriting business moves against the market return. And so the underwriting business then is a good risk diversification for shareholders. And that's why they then accept a negative underwriting return. The benefit of the underwriting business is then actually this risk diversification. It provides a hedge against holding shares, the risk of holding shares. In that case, a negative underwriting return is equivalent to the positive market return yeah, that's what it is. In that case, the underwriting return is equivalent to the positive market return. The underwriting return may be negative, but you have the benefit of this risk diversification. It gives you a hedge for your shareholdings because it moves against the market return. Now we have here a few numbers. That's out of the Zweifel and Eisen book. So it's American data on American non-life insurance. So it's property insurance. Now, insurance companies invest conservatively, so their beta P is relatively low. You see, they avoid risk. So a change in market return by 1% will cause only a change in the portfolio of the insurance company by 0.3%. The portfolio of the insurance company is more stable than the market. And that's because they invest relatively conservatively. You see, insurance companies should not speculate. So their returns on their portfolios, on their investment portfolios are quite stable. Now, the normal rate of return of the market portfolio, let's assume it's 10%. Now, the data are a bit older. Today, naturally, mu M is not 10%. It will be less. Interest rates are less nowadays. The risk-free interest rate, that's assumed to be 3%. Again, it's American data. And with this information, you can now calculate what the return on the investment portfolio of the insurance company should be. Just plug it in here into the equation for the capital asset pricing model applied to the investment portfolio of the insurance company. So here we have RF is 3%, then the beta is 0.3, and then the market return is 10%, and then here we have again the risk-free interest rate. So the capital asset pricing model predicts that the return on the investment portfolio of the insurance company should be 5.1%. That's the optimal return on the insurance company, or on the investment portfolio of the insurance company. If the return is less, then the insurance company does not do a good job investing its funds. Now the beta U, again, you have to look at the data here, shows us that the market return on underwriting and that the market return and underwriting return are only weakly correlated, weakly negatively correlated. So this actually means that the underwriting business is a good hedge. You see, the underwriting business is maybe independent of the market or actually even moving weakly against the market. When market returns go up, then the return on underwriting business goes down, and vice versa. So underwriting business provides a good hedge for shareholders. The funds generating factor is 1.5. So that's what you get from annual reports of insurance companies. Now with that information, you can now calculate what the optimal underwriting return should be. Again, you plug in everything now here into the insurance capital asset pricing model, and you get minus 5.2%. So here it's optimal to have a negative return, a negative underwriting return. And it makes sense because underwriting is a good hedge for shareholders. The underwriting business, the return on the underwriting business moves against the market return. Okay, so when we had to start at the beginning, in the last lecture at the beginning, that Zurich Insurance has a negative underwriting return, so that's not so unusual. And it happens quite often with insurance companies. Then the benefit of the underwriting business is actually the hedging. It's the diversification that it gives to shareholders, because the underwriting business, the return moves against the market return. So then here we have the leverage ratio, again, that you get from the annual report of insurance companies. And with this information, you can now calculate the beta K. Now use here, I think it was equation 26. Beta K is a weighted average of, no, it was a later equation. beta k is a weighted average of beta p and beta u. You plug in all the numbers, you get 1. So the return on equity moves 1-to-1 with the market return. That's just the case here with those data that we have. And because the return on equity moves 1-to-1 with the market, then the return on equity should actually be equal to the market return. The return on equity of the insurance company moves together with the market 1-to-1. So basically, the two investments are equivalent. And so that's also what we actually confirm down here. If you now plug in the numbers here in the equation for the return on equity, you get indeed 10%. So that's pretty neat. Okay, it's a nice example. Look it up in the Zweifeleisen. I have it from the Zweifeleisen book. So we can now use this. We know the mu. Yeah, here we have it, 5.2%. So we can now calculate the optimal premium income. Just plug it into equation 32. Here we have 5.2%. So you get actually the optimal premium income should be 95% of the expenses of the insurance company for payments to insurance buyers and also for underwriting expenses. Remember, LN is now the total expenses. And you can rearrange this, okay, and you get also here the combined ratio. So just rearrange, get ln divided by pi, you get a combined ratio which is more than 1. So the expenses are bigger than the premium income. So we have a loss on the underwriting business. So it's quite normal to have a negative underwriting return and a loss on the underwriting business that's bigger than the premium income. It happens, I repeat here, it happens when this beta u is small or negative. Then the underwriting business provides risk diversification for the shareholders because return on underwriting moves against the market return. It makes your portfolio or your wealth then more stable. Now I finish here with an example from German car insurance. In the 1990s, the German government wanted to do something that's popular with insurance buyers. So it introduced a ceiling on the underwriting return of 3%. So this was just the highest underwriting return that an insurance company was allowed to have. It was an admissible rate or ceiling on the underwriting return. So that's obviously a political issue. The German government just wanted to help insurance buyers. But when you plug this now into the equation from UK for the return on equity of the insurance company, and you use the same figures as before, then you get now here a return on equity which is 26%, which is very high. So this was quite useless, this law. You see, they wanted to do something in favor of the insurance buyers, so they had this ceiling here on the underwriting return, but it was a useless ceiling. It actually implied a very high return on equity for the holders of the shares of the insurance company. So actually, really, with the data that we have here, it's optimal for the shareholders of the insurance company to have a negative return. And the German regulators were not aware of this. Naturally, the there could not be a regulation here to have a negative return. That would be politically not feasible. So, but they made a mistake here. They did not understand what is going on here. But that was a while ago, so probably by now they no longer have this ceiling here. It implies a very high return on equity of the insurance company. So it really actually, it would be too large. And the insurance company voluntarily has a lower underwriting return. Okay, that was the lecture of today. Thank you very much.